Hi, my name is John Gigliello, certified financial planner with the Albany Financial Group. And I just wanted to take a moment to address the most recent volatility in the stock market, and specifically to share some thoughts from LPL Financial's chief market strategist, Ryan Dietrich. Now, stocks have certainly got off to a tough start in 2022. But why? Why has the market pulled back? And what might we see going forward this year? Well, first of all, we think the most important thing to remember is that periodic stock market volatility is entirely normal. Historically, the S&P 500 index has averaged 3 pullbacks of 5% or more per year and 1 correction of more than 10% annually. Now, investors have grown accustomed to this steady, consistent gains over the past couple of years, which makes the current environment a pretty bumpy ride, and it feels uncomfortable. After only a single 5% pullback in 2021, we've been anticipating more volatility in 2022. But even though volatility is normal, it is usually responding to something. Stubbornly high inflation, higher interest rates, and less support from the Federal Reserve are getting most of the blame, and probably deservedly so. Supply chain disruptions and some economic weakness because of the Omicron variant of COVID-19 are certainly playing a role. Additionally, market history tells us that stock market action in midterm election years, which we are in right now, are historically quite volatile, and most gains tend to happen in the back half of the year. So while we expect inflation to start improving soon and the impact of the virus to fade, the Federal Reserve has shifted its priority to controlling inflation. That signal of less support for the economy has made markets very nervous. The good news, though, is that the Fed is prioritizing inflation because the economy overall is in pretty good shape. Since that's usually true when the Fed starts to hike interest rates, the S&P 500 historically has a solid performance on average in the year before and after the first rate hike of an economic expansion. Importantly, we still remain confident that corporate America has enough earnings power still left to support stock market gains this year. They are certainly challenging times, to say the least, that face corporate America this earnings season, including supply chain disruptions, wage and other cost pressures, and the COVID-19 Omicron variant. But while it's still early in the earnings season, corporate earnings are growing strongly, and companies are mostly optimistic about the future. This pullback in the S&P 500 could easily go to 10% or even a little bit more. Remember, the average maximum drawdown in a positive year for stocks is about 11%. But based on the still solid overall economic and earnings backdrop, our expectation is that the inflation clouds will soon start to clear. And with the stock market's historically solid track record early in Fed rate hike cycles, we wouldn't expect this pullback to go much further. Here's to a successful and healthy 2022. Please remember to stick to your financial plan. It's there for a reason, to provide stability and clarity in times like this. If you don't have a financial plan in place, or it's been a while since it's been updated, please give us a call so we can help. Thanks for listening.